What is happening, people? It is your boy Jack. I am not a financial advisor, and today I'm going to attempt the impossible. I'm going to attempt to find some stocks that are undervalued or are good buys in the current market. I mean, it has been a crazy week. American Airlines went up nearly 100%. Carnival Cruise Corp went up close to 40%. We're speaking about Carnival here. The S&P 500, Dow Jones and Nasdaq are all seeing green days left, right and center. The Nasdaq hit all-time highs. My portfolio went from red or around break even to green, up over 8% at one stage. My Delta has gone from being in the red for the longest time to up nearly 40%. And last but certainly not least, Indian officials have finally caught a Pakistani spy pigeon. But really though guys, trying to find value in the market right now is like trying to find a needle in a haystack. Usually I make these kind of videos where we speak about 10 stocks to watch next week, and I can just pick any 10 stocks, you know, I'm like, I'll have one of you. It's easy. I spent more time trying to figure out some stocks that I actually think are worthwhile today than ever before. And I've come up with 5 growth stocks and 5 dividend stocks that I think are either, you know, at a good price now or worth keeping an eye on for, you know, if there's a little bit of a dip to get in at a nice price. There has just been some insane movements across the board. And before we get into the video, I'm going to say that today I'm not going to cover any of the FANG stocks. So there's no Facebook, there's no Apple, there's no Google, no anything like that. Just because they are pretty much, in my opinion, always stocks to watch or consider buying, so I don't want to cover them every video. And I will actually make a full video on them very soon. But right before we get into the video, guys, can I ask you to please smash a like? Let's see if we can hit 400 likes, you know, these videos generally do well. Let's get 400 likes. Drop me a sub if you're new around here. We are trying to get to 10,000 by the end of July. We are well on track. It's crazy. And lastly, drop me a comment, let me know what stocks you are keeping an eye on right now, or what stocks you think are good value, because I'm sure a lot of people in the comment section will appreciate you massively, because right now, not a lot of stocks are looking tasty. So with all of that being said, guys, let us get straight into the video. So quickly before we get into the 10 picks of today, I want to speak about a video I made on the 26th of May, okay? 5 crazy cheap stocks, or are they, okay? 5 stocks down 50+%. If you're not interested in this, I'll leave a timestamp in the corner right now so you know exactly where to go to see my first stock pick. But I want to show you how all of these companies have performed since I made this video, just to put into perspective how crazy the market is moving. Keep in mind, these were some of the absolute worst performing stocks in the market. So Delta Airlines was the first company. I spoke about them right here on the 26th of May. Since then, they've gone up 33%. Simon Property Group next up. They've gone up nearly 50%. I am kicking myself over this company, guys, because I was looking so hard to get into an REIT. I wanted to buy them. I don't know why I didn't. But anyway, I just want to show you how crazy the market has been. Wells Fargo, you all know where I stand with these guys. Even Wells Fargo are up 20%. CCL, everybody's favourite company, up 32%. And lastly, we have Oxy, up a massive nearly 45%. I just want you all to keep in mind that these were some of the hardest hit companies at the time of me recording that video, and they have all performed absolutely incredibly. And that's why I've kind of made it my mission to go out and find some stocks that are still down more than the market is, because I believe they're going to be the best value as long as the fundamentals are in place as well. So that's what today's video was really about. It was about trying to find some companies that I think are still going to be a good buy, or could be a good buy if even a little bit of a dip happens. So with that in mind, let's get into the first company of today. We're going to start off with my 5 growth stocks and then my 5 dividend stocks after. Now look, I have to start it off with an airline stock, okay? And I'm going to speak specifically about American Airlines, but this does apply to pretty much every airline stock right now. I'm sure you're all aware of just how well airlines did last week. I made a full video on airlines yesterday, so if you want my full thoughts and opinions, check that out, but we'll keep it short and sweet. So on the 6-month chart, having a quick look at American Airlines, you know, from the top down to the very bottom, we dropped over 70% in value, okay? And as of right now, they're down about 40-ish%. Last week, there was a stage where American Airlines was up extremely close to 100% in the space of a week, guys. They closed the week still up 72%. You all thought I was crazy for buying Delta and for buying Southwest, and look at me now, I'm in a good place. I'm getting the question all the time, am I selling? No, I am not selling, I am holding, regardless of what happens next. So I won't get too into why this is happening, but here are the basics, okay? More than 3 times the amount of people are going through TSA as of right now than they were only back in April. American Airlines came out, okay, and they said that this July they expect to have 55% the number of flights that they had last year, and that's in July. We expected the recovery to be slower. And there's generally just a lot of news coming out about, you know, countries, entire countries opening back up to the public for holidays. You know, they can go to the country, they don't have to quarantine, they can do whatever they like. So essentially, there's just a whole lot of positive news in the world of travel right now, which is pushing these airlines up. And you can go look at nearly any airline whatsoever and you will see an immense gain this week. And all us airline investors are very happy. A lot of people have the question now, is it too late to buy? And I think it depends on what you want out of them, okay? To me, my airline stocks were my high risk, high reward stock. So for me, it wouldn't really make too much sense to buy at these levels, because I might be looking at, you know, 100 to 150% return in the next year or two if I'm quite lucky. Whereas on the flip side, if you were to buy down here, you can be looking at 300-400% in the next year or two if we're lucky. I still think from a long-term point of view, here is going to be a fantastic price point. Here is probably a fantastic price point. At some stage, I think they will make you money. But if you were wanting to get on the hype, to get all of the growth, I think that train has left. So that's number one. We have American Airlines and pretty much every airline. So number two, oh baby, it's going to be a controversial one today, okay? Last time I spoke about Wells Fargo, I was down 30% on my position. Since then, I've bought a little bit more, I've got my cost basis a little bit lower, and I'm currently down less than 8% on my position. And this is largely due to the fact that over the last 3 weeks, they have gained 40% from their lows. And what I think I've learned this week, okay, majorly, is that if you believe in a company in the long term, which is what I did with Delta and Southwest, you should not worry if you are down 20, 30, 40% in a company. If you believe in them, from now on I'm going to see that as an opportunity to buy more. That is just me. Again, I have the hoodie to say I'm not a financial advisor. That does not mean that's what you have to do. But with me, that's exactly what I did with Wells Fargo. And as of right now, it's paid off. Now, you can say what you want about Wells Fargo. I don't expect a lot of people to agree with me. I know that they have a shady history. I know that they've had fake bank accounts. I know what there is to know about these guys. I still think they're going to be fine. I think they're going to give me back an awful lot of money. And I consider these guys to be a growth stock. And they have close to a 6.5% dividend yield. If you know me, you know that I absolutely love a company that I see to be a growth stock that also has a massive dividend. So for me, I'm willing to take the bet on Wells Fargo. I see the best of both worlds. I understand the risks. I understand that they could most certainly go lower. And if it happens, I'll buy more because I've decided I am very confident in this company. I also own a position in JP Morgan, and I'll throw that on the screen right now. It's a relatively small one, but it's doing quite well for me. And JP Morgan, from their highs to where they are now, is down less than 20%. Wells Fargo is double that. They're down over 40%. So for me, Wells Fargo is one of my higher risk, high return plays, okay? Similar to what Delta was to me. So it makes more sense for me to invest in Wells Fargo, even though the future of them isn't as certain, you know, isn't as promising as JP Morgan. Because I do believe that they will ultimately pay me back more money at this price. I see JPM as a little bit of a safety net, okay? Similarly to the way I didn't just buy Delta, I bought Southwest as well. If one does particularly poorly, the other one may well offset some of that loss. But Wells Fargo is my favourite one because they're down a considerable amount. So I'll leave that there. That was company number 2. Okay, Visa, a company I spoke about recently and a company I don't actually own yet. And I'm not sure why. I do want to buy them. I just didn't buy anything this week because of how good the market was. But Visa is one that I definitely want to buy very soon. So we're going to start off on some shorter time frames and work our way up, okay? So we'll start on the last month. And what we can see is we'll go from the lows. In the last month, Visa's returned 12.72%, so very good. In the last 6 months to where we are now, they're only down 6.42%, so pretty much even with the market. But historically, these guys have grown a lot faster than the market, okay? So we go year to date, and we'll take it from the start of the year up to the highs before the dip happened, and they were up 27.79%, so very nice. And now things start to get juicy when we go down to the 5-year chart, and again, we go back to the start, we go up to those peaks, and that was 200% plus in 5 years. Then we'll go over to the max stock chart, okay? And let's go from the end of 2010 up to those peaks, and boom, over 1,000, well over 1,000% return, guys. And I see no reason for this growth to slow down, and here's why. They're an absolutely massive company, okay? There's not many competitors, okay? MasterCard might be their biggest competitor. The odds are you probably have a Visa card within 6 foot of you right now. A lot of the world is moving online as well, you know, e-commerce is going up and up and up in popularity. So the likes of Visa will benefit from that, you know. Cash is sadly slowly but surely dying off, and Visa will be able to take advantage. And this here was the first major dip Visa ever saw, and the recovery was quick. I mean, a matter of a few months, and they're pretty much back to where they were. And aside from that, it's just been up and up and up. So again, if you know me, you know that I am quite practical in the way I trade. I just like looking at companies who I believe in, and then if they have the fundamentals and they have the balance sheet, blah blah blah, everything to back it up, That's the kind of company I want to invest in. Visa is very easy to understand, and it's very easy to understand why they should do well going forwards, and that's why they're making the list today. I think this is one of those companies that I would buy pretty much at any price. Even if they were back at their highs, similar to the way I bought Facebook at the highs, I'd be relatively happy to do so from a long-term perspective. So that was Visa. We have 2 more growth stocks. Okay, they had to make the list. Simon Property Group. It pains me to speak about these ones because, again, they've been on my radar for months. Literally months. Back, where are we? If we go to the 6-month chart, I was watching them all the way from around this price point. And then when they dropped around the $60 to $50 mark, there was so many times I had my phone open, and I don't know why I didn't just click the buy button, because I wanted a rate, and Simon Property Group was my favourite one, aside from Realty Income, who I already own. Lessons learned, lessons learned. So from this month lows up to the highs, they're up over 72%. I am kicking myself massively. Now the question is, do I think it's too late to get involved? So on the 6-month stock chart, these guys are down about 40ish%. So, you know, far worse than the S&P 500 is doing. Does that necessarily mean it's a good price to buy? Potentially. So the main thing that kept me from buying these guys, okay, is that most of their locations are anchored by department stores, and the vast majority of net operating income is derived from the company's US malls, okay? Now, just when we were speaking about Visa, I said that I see an awful lot of the world going online, and I mentioned this in a previous video in regards to SPG, okay? I don't really like investing in these rates that are to do with malls or department stores, whatever it is. Now, I also completely understand there's not going to be a world where every mall disappears off the face of the earth. That's not realistic. It's an experience in itself. People enjoy going to these malls. It's something to do, you know, it gets you out of the house, you can have a look around. It's a different experience than shopping online. I mean, nobody meets with their friends or their family and sits around a laptop and order stuff online. Whereas when you go to the mall, you know, you get yourself some food, you have that social interaction, and there is some shopping. So I'm definitely not saying that I think malls are going to disappear off the face of the earth, but that was the only reason that I didn't get into these guys, despite the fact I thought it was a good investment. But lesson learned, I had these guys on my radar for a long time. I did the research, I did believe in them despite the fact I don't believe in the malls, and I missed out. And you know, sometimes you're going to miss out. That is the nature of this game. You're not going to take every opportunity that's thrown at you. It's really difficult for me to say whether I would be happy to buy at this price or not. More than likely, I won't be. Not because I think it's going to go back down or because I don't think it's ever going to make new highs. I just don't think it's for me. I think I could put my money into different companies and feel better about it and get more money back and not worry about it quite as much. But I still wanted them to make the list because I know a lot of people will have a big interest in these guys, and hopefully I can put it onto a few new radars. Just go ahead and analyze them, form your own thoughts and opinions, and let me know how you get on with them. Okay, and the final growth stock for today, another company I'm kicking myself over. We have Carnival, okay? And again, similar to the way I spoke about American Airlines, this applies to pretty much every cruise line, or at least Royal Caribbean and Norwegian Cruise, the big 3 players. From the 6-month highs to where we are now, they are still down close to 60%. And what's crazy about that is that comes after a 170% recovery. Seeing that number makes me sick to my stomach, because when they dropped below $8, I was on my phone that entire day and I was going to buy 30 or 40 shares of them, and I just never did, because again, I was a new investor, I was nervous, I wasn't willing to risk the money. Whereas now, if I was back in that situation, I would have been. But again, lessons learned, they are invaluable. Next time I see an opportunity like this and I find a company that I do believe in that has been hit particularly hard, I will know to pull the trigger, baby. Now, the reason I'm not too upset about this is because I've always seen Carnival or any cruise line as a slightly higher risk, high reward airline. Reason being, the cruise lines got hit a bit harder, they had no government support, and they wouldn't have been able to survive as long, and it's going to be longer before they're taking passengers on. So from the start, I understand that these guys would get hit harder and more than likely will be able to return more money than the airlines, but I just felt slightly safer putting my money in the airlines, and it's worked out as well, you know. And again, hindsight's 2020. If you're to get in here, absolutely beautiful. But the reality of it is, most people got in here, around the $10 to $15 mark. And if you got in there, you're only up about 43-45% depending on exactly where you get in, which is very similar to what I am on my airlines. So I have no regrets in not getting into Carnival. I'm very happy for those of you who did at the low price and have made a lot of money. That was a sick opportunity and you guys took it. Now, do I think it's too late to buy? Again, similarly to the airlines, when you've already missed out on 170%-ish of growth, if you've missed out on 100% of growth, I don't know if it's worth it. You get in at $20 now, let's say, and let's say at some stage it gets back up to $50. You're going to make 150%. It's not going to get there anytime soon. Whereas if you're one of the people who can get in at $8, you are making what? Over 600% when that gets back up to 50. And if I'm going to invest in a company for the sake of a 150% return in a matter of a few years, I think there's a few safer bets. Sure, I might not get 150%, I might only get 50 to 100%, but I think it's an awful lot of a better risk to reward ratio than Carnival is right now. Now I know, again, a lot of people will disagree, and that's fine. But they had to make the list. I still get asked about them the whole time. That's Carnival, and that is the 5 growth stocks. Now we have 5 juicy dividend stocks that I still believe are at a fairly decent price. The first company we're having a look at is Altria. I have a full video on these guys, speaking about them in depth and why I believe in them, so I won't get too into it. But what I want to show you before we get into any of these dividend stocks is the S&P 500, okay? And I just want to show us the fact that right now the S&P is only down about 5.3% from its 6-month highs, from its all-time highs. So the S&P is nearly back to where it was. So if we can find a company that, you know, we believe to have good long-term fundamentals, we believe will survive and will ultimately pay us back a lot of money, below the 5% mark, to me, that's a quality stock. So Altria, from the highs to lows, is still down, you know, close to 19%, so considerably more than the S&P's just over 5%. And something else about Altria is they have this 8% dividend yield, and I believe personally that dividend to be very safe, okay? If we go down here, they are a dividend king, okay? A dividend king, a company who has paid and upgraded their dividend for over 50 years straight, that has an 8% dividend yield. You will not find that anywhere else. Again, I'm not going to go into depth on this because I have a full video and most of you guys have probably seen it. But they're in so many emerging markets. They're in Kronos Group, they're in cannabis, okay? Abinbev, they're in the global beer industry, okay? IQOS, a global heated tobacco leader. Juul, a leading e-vape brand. They've not performed as well as expected, but again, I'm not going to get into that. And on oral nicotine pouches. Less and less people are smoking every year because everybody is becoming more health conscious, but everybody still wants their nicotine kick. Things like IQOS, Juul, and On are great markets. The people who quit cigarettes often go on to a vape, they often go on to nicotine patches, whatever it is, so that they can still get their little buzz. Kronos Group, in cannabis, okay? An extremely emerging market, extremely. I'm probably going to invest in Kronos myself outside of Altria relatively soon as well. We'll save that for a different day though. And then Abinbev, okay, they sell Bud, the likes of that, the global beer industry leader, and they have 10% in them. So they have their foot in a lot of different markets. Historically, okay, this stock chart is beautiful. Now, the last 3 years have been poor. The last 3 years have been poor, I will give you that, I will hold my hands up. Why is it going to change? Because they're taking action. They're taking action to getting into these emerging markets. They're making sure a change happens. And you want to see, if you invested in these guys back in 2009, okay, shortly after the Great Recession, up to the top, they would have given you, where are we, over 400% return in less than 10 years. And let's just say you invested back in 1980, you know, they would have just given you back a light close to 20,000%. So again, personally, I'm looking at a company that I believe has the potential to be a growth stock that has an 8% dividend yield. It ticks all of the boxes for me. Now, I understand a little bit more risk comes with these guys. They're definitely not a Pepsi. They're definitely not one of the safer dividend paying companies. But you're not going to get a safe one if you think it's a growth stock and it has an 8% dividend yield. That is Altria anyway. That is company number 1. So on to our second pick. We're having a look at Coca-Cola, guys. And I am genuinely very surprised at how these guys are performing, okay? So from the highs to where we are now, they're still down very close to 20%. This is Coca-Cola, guys. This is one of the biggest brands in the entire world. Everybody knows who they are. They have a dividend yield of 3.34%. They're a dividend king. Where are we? An uninterrupted dividend streak of 58 plus years. And simply put, it's just Coca-Cola. I don't see what else needs to be said. Now, in recent history, these guys haven't been the best stock in the whole wide world. What they have done is, you know, given some sort of a relatively safe 10%-ish return every year. And that 3+% dividend yield. So to me, if I can pick them up at a bit of a discount, you know, even if it is a 20% discount, I think it's fair in the long term. I think it's the kind of company you're going to be able to buy and hold forever. And at some stage, they're going to pay you back a decent amount of money. They're not the most exciting in the world, I'll admit that. They're not going to pay you back thousands of percent. But, you know, a relatively safe, somewhat defensive investment that has been hit harder than I believe it should have. I do prefer Pepsi, but you know what I mean? Pepsi hasn't been hit as hard, so Coca-Cola is making the list for that reason alone. Next up, we have Sysco Corp. And I know a lot of you guys are in this company because you've let me know in the comments that I put it onto your radar, you did your analysis, and you've made a whole lot of money, so happy days. And I'm very happy with these guys too. I'm up over 30%, so one of my best performing investments so far. So, you know, very happy. So again, from the highs to where we are now, we're still looking at a company who is down over 25%. So still down massively. Nearly a 3% dividend yield, okay? And again, a dividend king, a 51 plus year dividend streak. And it's just another company where when we look at the max stock chart, they played a massive role in the bull run since 2009. It's been some really nice growth. Since 2009, they were paying back over 250-ish%. I never even looked at this before, but since 1980, they've given back over 30,000%. Not that that's very relevant, but yeah. So again, like with most dividend stocks, like with Coca-Cola, not the most exciting company in the world. I don't think they're going to pay you back thousands and thousands of percent, but a relatively safe company who I think has been hit hard, who will more than likely keep paying you a dividend forever and ever. If you've never looked into this company, I strongly urge you to do so, and obviously do your own analysis, form your own opinions, but what they do is they're the largest global distributor of food in the world, okay? They essentially act as middleman between food producers and retail consumers. And the reason these guys would have got hit so hard is because restaurants take up 62% of their sales, schools and governments 9%, hotels and travel companies 9%, healthcare facilities 8%, okay? So pretty much everybody that these guys give food to would not have needed anywhere near as much food and could have, stopped ordering, things along those lines. But somewhat similarly to airlines and anything to do with the travel industry, when restaurants open back up, when countries open back up, when schools, everything opens back up, these guys will benefit very quickly because they will all have to put in their orders for food again. So that is Sysco. If they weren't on your radar, please go look into them. I know a lot of people don't have them on the radar at all. Okay, so we have two more companies now, okay? And the first one is Exxon Mobil, okay? I love Exxon Mobil to pieces personally. We're looking at a company who dropped over 55% from highs to lows and is still down again 25%. Again, I do have a position in these guys. I'm up about 10%, so I'm quite happy with my cost basis, and I do expect these guys to pay me a considerable amount over the years to come. Dividend yield 6.5%. And again, a 37 plus year uninterrupted dividend streak. So a very long uninterrupted dividend streak. It's clear to see why these guys got hit very hard is because of everything that's going on in the world and oil. These guys are in upstream, downstream and chemicals. So obviously they just got hit left, right and center. It's one of those companies that is absolutely loved by long-term dividend investors. I think a lot of them deem it to be a very good investment. And it's because of how safe that dividend is and the fact that that dividend is so high at 6.5%. They have had a shaky past 5 years, okay? It's been trading very sideways, but keep in mind that whole time you're getting that 6+ dividend yield, it takes away from it a little bit. So if we are to see the next oil boom coming out the back of this, when oil demand goes right back up, I think that this is going to be one of the companies that benefits massively. So getting into them at some sort of a discount seems fantastic to me. Okay, and the final company we have is EPD. And what I will say quickly is you could also throw Pembina Pipeline in there. I do own both of them and I do absolutely love both of them. But I want to speak about EPD today. So there you go. From highs to lows, these guys went down over 57%. And as of right now, they're still down 27-ish%. Similarly to Exxon, these guys are in the oil industry, okay? They're one of North America's largest midstream MLPs with about 50,000 miles of natural gas liquids, crude oil, refined products and petrochemical pipelines. I love saying petrochemical pipelines. It just rolls off the tongue. The firm also owns a number of storage facilities, processing plants and export terminals. So again, not much needs to be said really, aside from the fact that they would have been hit very, very harshly because of oil. Now, it's another company who for the last 5 years have not done so hot. Whereas when we look at Pembina Pipeline, they've done a considerable amount better on that 5-year chart. They've given back over 80-ish%, whereas EPD on that 5-year, they've given back pretty much nothing. But I do always like going back towards the end of the Great Recession when it comes to looking at oil-related stocks and seeing how they've done. Because, off the back of those things, oil wasn't in high demand. Now it is. We're going to go up, and they went on this very nice 275% spree in the case of 5 years. So to an extent, I see EPD as a little bit higher risk than Pembina, but I do own both, and I do absolutely love both, and I will more or less just buy them in equal amounts, to be completely honest with you. But yeah, guys, they were the 10 stocks that I will be keeping an eye on next week. Hopefully I was able to put a little something onto your radar, because I know a lot of people are quite scared of investing right now because of just how many green days we are seeing, and I'm in the same boat, When everything was just going down, it was just like buy, 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 buy. You didn't really have to think about it too much, but now we have to get a little bit smarter. I hope you all enjoyed some really nice green days last week though, especially you guys in the airlines, the cruise lines, all that stuff. I hope that you had some tasty days. But yeah guys, that was it for today's video. I really do hope that you enjoyed. If you did, again, please smash that like button, drop me a comment, let me know what you thought down below, and subscribe, join the family if you are indeed new around here. With that being said guys, have a fantastic day. I will catch you all for tomorrow's video. Peace.